Good evening, friends. It's been a while, but yes, back again to revisiting some of the key behavioral tenets of investing, which to my mind are the most crucial aspects to wealth creation. While, of course, nobody can undermine the relevance of knowledge pertaining to the art and science of investing and the fundamental and technical study around it, investment psychology during the investment phase plays a pivotal role in the compounding of ideas and, of course, money. We are often driven and influenced by fear and other times by greed, sometimes by impatience and other times by regret. The key to being a successful investor lies in maintaining composure during periods of upturns and downturns and not allowing oneself to be dragged into either exuberance or pessimism during these inevitable moments. Inevitable, yes, cause it's the nature of the markets to behave in a non-linear fashion regardless of the direction that it is slated to go in. So, what are the key things to keep in mind for us to be able to avoid mistakes in the future and become more successful investors? So, first and foremost, the ultimate truth related to the markets. Markets mean revert. This simply means that regardless of the quantum of rise or fall in the markets have an inherent inclination to revert to the long-term averages or the mean of the long-term prices. As quickly as we understand and accept this truth and embed it in our investment psychology, we will be certainly more accepting of the changes and fluctuations in the market. If you have researched well and invested in fundamentally good stocks or mutual funds, then there is absolutely no reason for you to be overwhelmed with fear and grief over having lost out on profits or sometimes even capital in a downturn. Why? Because eventually, if the stock or mutual fund where you have invested is representative of a growing economy, then it will come back after a while. And these periods of downturn actually provide you with magnificent opportunities to incrementally invest in the market at lower prices. This is known as rupee cost averaging, which of course reduces the impact of volatility too. Secondly, don't overestimate your abilities and never underestimate your risks. Both have to do with overconfidence and are interconnected. When your investments are doing well and your decision making has been successful, there will always be a tendency to believe that you know everything. Believe me, the best of fund managers and analysts also don't claim to know everything, and for what they know too, they too have been proven very, very wrong at times. So confiding in this self-notion about I know it all leads you to digressing away from the fundamental notion of adequate diversification and the overexposing yourself to your most convincing bets. And then during the downturn, because they are disproportionate, the damage to the portfolio is even more excruciating than ideally it is for the market as a whole. So being confident is a good thing, but being euphoric is most certainly devastation in the waiting. Thirdly, trying to time the market. Your past bad experiences often affects your way of thinking in terms of finding the right time to invest even when the markets have come back and are rising. The true way is not about finding the most appropriate time to invest, but learning to look past the media headlines. Push aside inherent impulses to act certainly and stay true to your reasons of investing and staying focused on the plan. You need to be certainly informed and hence seek information from credible and factual sources to arrive at inferences, but certainly the objective must not to be influenced by such news and noise around you. Whenever the mass follows the market and 80% of the people start thinking that way, either at the top or bottom of the markets, please choose to be the 20% and allow your decisions to be the minority ones. This way, you can book your profits at the top by avoiding to be greedy and bringing back the asset allocation discipline by realigning the proportions of pre-decided levels of asset classes. And similarly, at the bottom, start investing at a time when majority of the people are very fearful, and also yourself avoid being overtly fearful in the process. Remember, the fluctuations in the market are a consequence of the collective emotional outbursts of the investors, and by choosing to be in the minority, it will most certainly help you leverage on the outpourings of the majority markets. Also, it will be unwise to take your decisions based on the first piece of information that you can access or is available to you. You often may use that information to confirm your already existing biases about a certain proposition, and then all your incremental investment decisions anchor around that, without feeling the need to visit the past or historical data, or maybe delve into some more fundamental data to be more certain about the likely results. Another issue that most people are confronted with is their overemphasis on preventing losses than making profits. Aversion to loss can lead to taking very little risk and preventing oneself from being relatively profitable. In most cases, the decision-making of investors, whether they are well-read investors or less informed retail investors, depends on their respective stakes and the extent of their stakes in a certain investment avenue. An investor who is heavily invested or has gone all in is most likely to talk relatively more positive about the market situation even when it is in the downturn. On the contrary, a person sitting on sufficient idle cash may continue to talk bearish for him or her to buy the same stuff at even lower and finer levels. So decide for yourself wisely and not on the basis of what somebody or anybody thinks. Albeit, an investor must invest unemotionally in the markets. If the goals are clearly defined and the same investor is well identified with his or her risk tolerance. Never go beyond a risk profile in any temptation, and this will help you take more rational decisions for yourself and your loved ones. But yes, if once your asset allocation has been ascribed, the return on it will be a function of the amount of risk that you have taken. In other words, greater the risk, more the return. If the chosen asset allocation is a balanced one, which means an appropriate mix of fixed income and equity, obviously the return will be a lot lesser than a portfolio which has dominantly equity in it, providing the equity market has been doing well. On the contrary, if the equity market doesn't do too well in a particular year or at a certain time frame, the balanced portfolio will obviously be more insulated from the market risk because of greater fixed income components in it. The point that I'm trying to make is that the returns will always be commensurate to your portfolio design and asset allocation, which entirely depends on the amount of risk that you may be willing to undertake through your portfolio composition. And hence, investor expectations at all points in time must be fairly tame so that it may not lead to lament or anger or the feeling of having missed out on anything. Investing can be quite simple if you religiously abide by the predetermined rules that you may have set for yourselves, but simple it isn't because we are often guided by our emotions and then at some point in time are led into taking exceptions. This is even true for many astute fund managers whose underperformance mostly can be attributed to going beyond the preset degrees of freedom, then maybe missing out on some deserving stock. So next time, before taking any evasive decision, think twice and think aloud and hold your horses. Believe me, maintaining composure during periods of volatility and depression will help you tide over the crisis in a better way. Because nothing lasts forever, nothing. So stay away from being led astray. Have a great weekend ahead. Until next time, bye-bye.